People who know me, Gladys, know that I like to sort of be on time. So I think we might kick things off. People can join as we talk. But look, for those of you who have joined us, hi, welcome to to our first session in our 7-week seminar series, which is Lunchtime is Money. A bit of play on words there. We're really looking forward to sharing insights with you and answering your questions as you spend your lunches wisely with us over the next 7 Wednesdays. The senior advice team at Hewison Private Wealth will be delivering all you need to know on topics such as asset allocation and portfolio rebalancing, which is what Gladys and I will be discussing today. We're going to talk about topics such as philanthropy, investing for income, and the overall investment landscape in the COVID era of 2020. Look, we're expecting the sessions to last about 45 minutes to an hour. We'll make sure that everyone's obviously being conscious of lunch breaks and so forth. We'll make sure everyone's out by 1, and we'll provide ample time for questions and answers at the end. We will try and answer some questions along the way if we can. Bear with us, this is the first time we've done a webinar like this, so we're going to try and use the technology as best we can. But please feel free to send as many questions as you like at the bottom of your screen, and we'll try and answer them along the way to make sure they're relevant. But if we can't get to them, we will answer them at the end. So look, as I said, we're wrapped that so many people have joined us today. We've had a really overwhelming response from, clients, as always, other business colleagues, business owners, hopefully soon to be clients and professional contacts. It's a very diverse group. So we'll work towards providing the information that will really help assist you managing your finances. And even if it just gives you a little bit of financial knowledge, financial literacy to help you make your own financial decisions. For those of you who don't know me, my name's Glenn Fairbairn. I'm a director and private client advisor at Hewison Private Wealth. I've been with the firm for 18 years. I'm also co-chair of our internal investment committee, and I'm co-host of the Money Mentors podcast. So a bit of a plug there for a social media outlet that my colleague Nathan and I run on a weekly basis, discussing things like this. That's all about just providing content and information to our clients and people who aren't clients. Today I'm joined by my colleague Gladys.
Hi everyone, my name is Gladys and I'm a Senior Associate Advisor. I've been with Hewison Private Wealth for around 4 years now, and I also sit on the investment committee with Glenn.
So Gladys, I'm not sure about you, but as an advisor, as soon as people know I'm an advisor or I talk to people, whether it's friends and family, a common question that I get asked is now a good time to be investing in shares? Should I buy an investment property? Should I leave my money in a term deposit? Should I buy some gold? Should I buy Bitcoin? Whatever it may be, that's a really common question that I get asked as an advisor, and I'm sure you and a lot of our colleagues do as well.
Yeah.
And it's really difficult to answer that question. And the reason being, and it's maybe a little bit cliche, but the way that I try and answer that question is by saying, would you go out and try building a house by buying all your tools and machinery and equipment first without actually having the plans? And I think that when we're looking at investing, we really need to consider it in very much the same way, in that you need to have a strategy before you even start thinking about what assets you should be buying or what investments are appropriate for you. And at Hewison Private Wealth, what we very much try and do is align the strategy with what the objectives of the client are. And if we break things up very simply, generally we can think about short-term objectives. So for example, it may be an objective to buy a car, buy a house, or go on a holiday. And if we're looking at those sorts of objectives, what we want to focus on are investments that are more short-term in nature. So what I mean by that are investments that may be things like cash and fixed interest, which are generally capital stable, like they don't usually change in value. And the advantage of focusing on those types of investments for shorter term objectives are that when you need the money for that objective, one, you know that you can get access to it. And two, you know that it's not going to be impacted by the movements of markets. So very important to have short-term investments for short-term objectives. But then if we start thinking about longer-term objectives, so for example, when people think about the long term, perhaps it's retirement. It may be a house deposit if you've got 5, 6, 7 years, but generally we're looking for those objectives that are beyond 5, 6, and 7 years. Now, when you have that sort of time frame, that's when you can start perhaps focusing on investments that are more longer term in nature. So things like shares and property. And although looking into history is not always an accurate predictor of the future, history has shown us that those asset classes, so shares and property, would generally provide the opportunity for growth over a long period of time. But the disadvantage of those assets is that they can fall in value in the short term. So if you've got a short-term objective, what you don't want to be doing, even if you think the market's great value, you don't want to be investing in things that may reduce in value over the time frame that you may need access to those funds, because that could really jeopardize the achievement of those objectives. So really what you want to be doing is only looking at those types of investments if it's an objective beyond 5, 6, and 7 years.
So we've put together a very simple case study here, just to reiterate what Glenn has just said. So we've got clients Mark and Kayla. They're both in their 40s and they received $500,000 in cash as inheritance. So they went to seek advice because they want to know what to do with their money. So after going through their circumstances and understanding what they are really looking to achieve, we've identified that their short-term objective is to go on a family holiday in the next 6 to 12 months, and they need $30,000. And really the long-term plan for them is to retire in 20 years, and they really want to make good use of the money that they receive to help them achieve that long-term strategy. So as Glenn was saying, with the short-term objective, we'll be recommending, short-term investments. So with that $30,000, we don't want to go out and, use that money to buy shares, because we know that shares, they can be volatile. And we've seen, obviously, over the last few months, the share market has been very volatile. And when time comes and when they need to pay for their holiday, we don't want to be selling shares to fund the holiday. So the recommendation would then be to, hey, okay, let's put $30,000 in cash so that when you need the money in the next 6 to 12 months, it's there to help fund that holiday. And with the rest of the cash, we'll then invest it in a well-diversified portfolio into assets like Glenn was mentioning, property, shares, and also some fixed income investments. And just something important to note is that there's nothing wrong with having multiple strategies working for you in a single portfolio. So with this client's scenario, they might start off by having a higher allocation to cash, and then that might change as once they achieve the short-term objective, and that changes.
And that's where it's really important we're biased in saying this, but if you're working with an advisor to really understand what your objectives are, to have, as you were saying, Gladys, it may not just be one strategy. If you've got 5 different objectives, you may have 5 different strategies working within the one sort of portfolio. And that really leads to the next point that we want to discuss. When we're talking about strategy, what we're really talking about from an investment perspective is an asset allocation. So what is an asset allocation? A lot of our viewers, listeners may have come across a chart like this before. This is very much a Hewison private wealth model. Now, when we talk about asset allocation, what we're essentially explaining or focusing on is where are your assets invested in percentage terms across the various asset classes. Now, at Hewison Private Wealth, we generally categorize investments into 5 different asset classes. So cash, fixed interest, property, Australian shares, and international shares. But for those of you who have seen a similar asset allocation before or an investment strategy, if you're looking at your superannuation statements, what you might find is that there's a lot more asset classes than what we're showing here today. There's really no right or wrong answer. It's very much opinionated. But for the purpose of today's discussion, we're really just going to focus on these 5 asset classes. Now, where an asset allocation comes into play is that ultimately where you invest your money will drive the returns of your portfolio. So quite often when investors are thinking about what's impacting the performance of their portfolio, they're thinking about specific investments. So it might be CSL shares in the last 3 months, or it might be their residential investment property in Malvern. But history has shown us, and a lot of research has been done in this particular area, that it's your actual asset allocation that has a far greater impact on the performance of your portfolio than individual investment selection. So that's where the strategy, being the asset allocation, is so important to get right at the beginning, because it will have a substantial impact not only on the performance of your portfolio, but also on your ability to achieve your objectives. Now, just to break it down a little bit further, to talk about these different asset classes, cash is probably one asset class that many people would be familiar with. We're talking about bank accounts and so forth. So liquid funds that you can get access to very, very quickly. Fixed interest, perhaps term deposits people are familiar with, but within that asset class, there's different types of fixed income. At Hewison Private Wealth, we generally, within this bucket, would include things like term deposits, secured first mortgages, bonds, private credit. So any investment where you're effectively providing a loan to somebody else, whether that be a government, individual, or a company, is what we'd categorize in fixed interest. Now, cash and fixed interest, those two asset classes, we would prescribe those as capital stable or income producing assets. So it's the part of your portfolio that really provides capital protection. So it's unlikely to be impacted by the movements of the share market or the property market. But within that, within fixed interest, there are different types. As I said, there's bonds, there's term deposits. Some of those fixed interest assets are listed on a secondary market. So if we think about corporate bonds or government bonds where you're providing loans to governments or businesses, those sorts of securities are listed on a market. So their capital value can change. So for shorter term objectives, it may not be appropriate to have a higher allocation to those sorts of fixed interest, whereas obviously term deposits over whatever duration, you know whatever you put in, you're going to get at the end, and you know what your rate of interest is going to be. So the reason I thought it'd be important to just spend a little bit of time talking about the specific asset classes is that within those, there are different types of investments that can perform differently at different points in time. And property is another perfect example of that. It's a really big asset class, but many people think about property, they think about their house or an investment property. But within that, there's different types of property. So you've got office, industrial, retail, as I said, residential, hotels. Now, although it's one asset class, each of those different subcategories can really perform very differently at different times. So at the moment, Gladys, there's a lot of people buying things online. So logistics, industrial property, inner suburban, they're actually performing quite strongly, but perhaps office hasn't got that same level of demand because a lot of us, as we are, working from home. So there's that sort of negative sentiment from that perspective. So the advantage of having an asset allocation is that not only can you spread your investments across different types of assets, but as we've discussed, you can actually diversify within an asset class as well. And that works the same with shares. I mean, there's different types of companies. So you wouldn't have all your money in banking shares. You might have some banking shares, some healthcare, some insurance companies and so forth. And look, why is asset allocation important? Well, ultimately, it drives the long-term returns of a portfolio. As we've spoken about, it has a far greater impact than individual investment selection. It reduces volatility. So if we talk about the hypothetical example of having all of your money invested in shares, well, if you had a portfolio like that, you would have bared the full brunt of the market downturn in March. The moment you start introducing other asset classes into the portfolio, what you're effectively doing is reducing the reliance on one asset class to drive the performance. So if you start introducing fixed interest, then you're reducing the volatility. And when we talk about volatility, what we're talking about is that just the fluctuations in asset value of a portfolio. So the more asset classes you've got within that, the better you're positioned to reduce risk and also reduce volatility.
Yeah, so in terms of how we determine asset allocation, so at Hewison Private Wealth, we do spend a lot of time trying to understand our clients, what situation are they in, and what are they really looking to achieve. Because at the end of the day, like what our clients' objectives are is what really drives the asset allocation, as Glenn has touched on previously. So we do look at a lot of things like, the client's experience in investing, as well as the client's attitude to investing. But one important thing is we don't risk profile. And what that means is we don't determine the client's asset allocation based on our client's risk profile. So very often with other advisors, you might, fill out a questionnaire which determines your risk profile, and then that dictates what model portfolio or what investments you are invested in. But at Hewison Private Wealth, we really seek to understand what your goals and objectives are. And we really, I guess we pride ourselves in, ensuring that our clients achieve their objectives by taking the least amount of risk possible.
And just to elaborate on that, Gladys, just in relation to, risk profiling, as you were saying, generally what a lot of advisors would do, and we're not saying there's anything wrong with that, but what they would generally do is provide the client with a series of questions about attitudes to investment. How would they feel if their portfolio fell by a certain level? How much experience have they got investing? And the answers to those questions will ultimately drive what we've been talking about, which is that asset allocation or that investment strategy. But what we've felt, and I've seen this a lot in my career over almost 20 years, investing through different cycles, is not everyone, but a lot of people tend to be quite aggressive when markets are rising, meaning that if the share market's rising or if the property market's strong, they tend to have greater interest in investing in those markets. Whereas when things get really tough, as we've seen, only in the last few months, in March when the market was really panicking about the impact of COVID-19, there was a lot of fear, there was a lot of anxiety. Now that can drive investment attitudes or investor attitudes. And as a result, I wouldn't be surprised if a lot more people became more conservative during those times. So in our view, not that we completely ignore the attitudes of investors or their tolerances to risk, but what we see our role is as advisors is to really, as Gladys was saying, understand your objectives, construct a strategy and a portfolio that can help you achieve those objectives. And then really our role is to educate you about the risks of the strategy or the portfolio required to achieve your objectives, what the potential consequences may be, and then work together to construct a portfolio that's really specific to your.
Yeah, and just one more point to add in terms of our investment strategy, it is dynamic. So we might meet with you and set up an investment strategy and asset allocation from day one, but that doesn't mean that wouldn't change. So as your circumstances and your goals evolve, your asset allocation will also change according to what your objectives are.
Yeah, and I think it's very important to clarify that from our perspective, your asset allocation should only change if your objectives change. Because what a lot of investors tend to do, as we're talking about the risk profiling and the attitudes being driven by the state of the market, what can be very tempting is that as the markets are doing well, you might say, well, my advisors said I need 30%. Markets are going well, I want to change that to 40. That's not what we're suggesting. And what we're saying is that if you have a strategy that's set up for the long term, you stick to that strategy. But if your objectives are changing, that's where you need to be speaking to your advisor about potentially making some alterations to your asset allocation to make sure that you can achieve those new objectives, once again, under our philosophy, without exposing yourself to unnecessary risk.
So once we've got your investment strategy and asset allocation in place, what we need to do is really proactively manage your portfolio so that we ensure that it remains in line with your initial target asset allocation. So we know that the market is not stagnant. The market is always constantly moving, and that's going to affect the asset allocation of your portfolio. So that's where rebalancing really comes in. So it's essentially buying and selling investments within your portfolio so that your asset allocation remains in line with the original target asset allocation. Because as we know, take for example, if the market has done very well, your exposure to shares would be a lot higher than it was. So what we want to do is then reduce your exposure to shares, because with a higher allocation to shares, that's going to change the risk of your portfolio. So when the share market, does very well, what we want to do is then lock in some profits and then reduce your allocation to shares. And same thing when the market fell early on in March when COVID hit Australia, we saw the share market fell by about 50%. And at that time, it was almost like a trigger point for us to say, hey, now the portfolio is underweight shares, it's time to buy more shares. So Glenn, just on the next slide, we've put together how it actually looks like. So if you have a look at the pie chart on your left, the target asset allocation for, let's just use Australian equity for as an example, is 20%. So when the market fell early this year, we saw the allocation to equities fell to about 15%. So what we did then is, buy more shares so that the portfolio rebalances back to the target asset allocation.
And look, as you were saying, Gladys, which I think is an important discussion point, is that when we're managing client portfolios, obviously the return is really important, isn't it? I mean, everyone's focusing on what return am I getting from my portfolio. But it's important to consider that when you're managing a portfolio, not to just focus on return without considering the risk. Because as we've seen in this particular example, the impact of a falling market, what can happen though, on the flip side, if the share market was rising, then your allocation to shares would increase accordingly. So as a result, the risk of your portfolio is increasing. Now, in a rising market, the more you've got invested in shares, obviously the better the return you're going to have. So you might think, well, I'm actually pretty comfortable having this higher allocation to shares because it's contributing to a outperformance of my portfolio. But if you continue to just ignore that and your allocation to shares continues to rise, then as you were saying, Gladys, the risk of the portfolio is changing considerably. And therefore, if you hadn't rebalanced at the back end of last year or early this year, then the impact of a falling market is going to be far greater than if you had rebalanced along the way. So once again, just important to clarify that you shouldn't consider return without considering the additional risk that you're taking along the way. And ultimately, as we've seen here, when the share market fell in March, what actually happened, assuming that all your other asset classes remained the same, like we can see here that fixed interest has increased to 45%. Now, as advisors, as Gladys was explaining, what we're doing is rebalancing back to what our target asset allocation is. Now, this is a hypothetical example of what happened in March, but we didn't know at the time that the market had reached a low point. But as you can see, the portfolio is actually telling us what we need to do throughout any investment cycle. So as advisors, what we don't need to be doing is picking, is now a good time to buy shares, is now a good time to sell shares, because the asset allocation that we've set in place at the very beginning, and then comparing that to the asset allocation as markets move, will dictate to us what we need to be doing throughout any cycle. So as we did in March with this particular portfolio, we were topping up. So as a result, what you're doing, if you do this right, you're disciplined, you're diligent, you take the emotion out of your decision making, then you can buy low and sell high and really set yourself up for the long term.
Glenn, we've got a question from Brett, which is relevant. I'm just going to read it out. So the question is, what approach do you use to identify which specific investments, as opposed to the asset class, are sold in the rebalancing process?
Yeah, that's a really good question. I might let you answer that, Gladys, because that was something that we were going to talk about, Brett, in relation to rebalancing within an asset class. So what we've focused on up to this point is rebalancing between asset classes. So for example, in that situation Gladys was walking through, the share market had fallen, so the client's portfolio allocation to shares as a whole had reduced, and we were looking at topping up. But there's also rebalancing within asset classes, Gladys?
Correct. So as Glenn alluded to at the start of the presentation, we also diversify within each asset class. So just to give you a real life example, one of my clients, we've rebalanced the portfolio when the market's down, buy more shares and all that. Okay, so the portfolio now is in line with the target asset allocation. But then when we look at the Australian equity investments of that portfolio, some shares have performed extremely well. And like, I'll use car sales as an example. So car sales has done very, very well over the last few months, and now it's even at a higher level than it was pre-COVID. So what we've been doing with this specific investment is we've been taking profits and then reinvesting that profits from car sales and buying other more attractive shares that has gone down in value. So that's also how we actually rebalance within each asset class.
Yeah, and it can be frustrating as well as investors and as advisors and even for clients when you're doing that, because quite often you're selling things that are really performing quite strongly. And that's when the emotion really kicks in, isn't it? Because, companies like car sales or CSL or other companies that have performed really, really strongly, you can get that emotional attachment to them. And I've had numerous conversations with clients about taking profits, and quite often the response is, do we really want to be selling that now? It's doing so well. But quite often with investing, it can be very much that contrarian approach where you might not be selling the winners, but as we were saying, if they're good companies, it's just trimming the profits along the way. Because what can happen is that if you've got a portfolio, let's just say of 12 stocks, one, two, or three of them are doing really, really well, and perhaps they provide exceptional returns, you don't want those 2, 3 companies having such a substantial impact on the overall performance, because we've spoken about the risk of being overweight an asset class, but you may not be overweight shares at all, but within that share portfolio, you may have a high degree of risk because you've got 1 or 2 stocks that make up maybe half of your portfolio. And that can be quite detrimental to the performance of your portfolio and also increase the risk of a portfolio. So quite often, unfortunately, when you're rebalancing in the short term, it can be, it can jeopardize the short-term performance, because you might take profits from shares or a particular company, and after you do that, they may continue to run. So you might sort of kick yourself and think, well, I shouldn't have done that. But that's where, as I was really trying to explain earlier, you want to take the emotion out of your decision-making and really consider risk as much as what you consider return. And ultimately what that does, as we're talking about with the third point here, it removes the risk of having to market time. So, a lot of people are always trying to pick the best time to buy, the best time to sell. Our philosophy is very much time in the market. So buy good quality assets, buy good investments, and hold them for the long term. But along the way, rebalance. So rebalance between asset classes and rebalance within a particular asset class, which may result in topping up or selling investments. And once again, that contrarian approach. So what we've seen quite often is that sometimes the losers this year can be the winners next year, because that's where the value is. So if you think about perhaps companies that are underperforming now, they may be outperforming next year. So there's a number of examples like that. So that's really where the rebalancing comes in. But Gladys, just for our viewers today, how frequently would you say you should be rebalancing a portfolio?
So generally we rebalance a portfolio. I mean, it could be 2, 3, 4 times or even more. So it really depends on a number of different factors, such as, the size of our client portfolio and whether they need to, withdraw any funds from the portfolio or make any further contributions. So it really depends. And over the last couple of months, we've seen that we've been rebalancing our client portfolios more frequently than we were before, because the market has just been so volatile. So while, as I mentioned before, the client might be, the portfolio might be in line with the target asset allocation, but we might be rebalancing within the asset class. So, I mean, in times like this, yes, we are rebalancing a little bit more, but Glenn, as you said, we are long-term investors. We don't buy a share today and then, sell it in 2 weeks or 3 weeks time. We are long-term investors. So we don't plan to buy and sell assets in the short term. So when, in normal circumstances, yeah, it could be about 2 to 4 or 5 times a year.
Yeah, and as you were saying, it really depends on the client situation. Like if they've got a regular savings plan and they're contributing large amounts each month, then you might be investing every month, or you might do it every couple of months. If it's a large portfolio that's generating a lot of income, they may be overweight cash because that income's building up, and you want to make sure, in particular, in this very low interest rate environment, that you're investing those funds and having them work as productively as possible. And I think, just Gladys, you would agree that the market has been quite volatile really since February throughout March. It sort of stabilized a little bit in the last few months. So as advisors, we're probably doing a lot of rebalancing during March because the market had fallen at 1.40%. So if you think about the impact of a 40% fall on client portfolios, if a client had a 30% target exposure to shares, 40%, well, they're getting down to sort of low 20% exposure to shares. So the portfolio is saying, well, we need to top that up. So you can see that the big swings in the market can result in more frequent rebalancing. And obviously we've seen a fairly swift recovery. So those clients who were topping up in March, not because we thought the bottom of the market had been reached, but because they were underweight shares, if we top them up, the market's now up 20%. They're probably overweight 10% shares now, so we're doing it again. But I suppose it's important just to clarify that it's not something that you want to be doing every month, because what can happen is the costs can far outweigh the benefits. So once again, it's just driven by these key factors, and that's where it's important to have an advisor who not only understands your objectives, but is really keeping on top of things and keeping a very close eye on your situation. We've just got a question here from Tom. Does the strategy remain the same for SMSFs? And is there a generally accepted dollar amount in super you would recommend a client establish their own SMSF? Look, that's where, as we said earlier, long-term strategies or long-term objectives are long-term strategies. So depending on your age, Tom, I think you've got 20, 30 years before you retire. So your strategy will be quite different compared to perhaps your parents, because you've got 30 years. So you may have a higher allocation to those growth type assets. So international shares, Australian shares, and property. Gladys, I'll let you answer the question about how much you should have before you start thinking about an SMSF or self-managed super fund.
Yeah. So this is a question that, constantly comes up when we workshop client scenarios. And, our ballpark figure is about, $400,000 to $500,000. So if you don't have that amount in your super combined, whether it's yourself or with your partner, it's really not cost effective to set up a self-managed super fund. Yes, a self-managed super fund will give you a lot of flexibility and control as to how you invest your super benefits, but then we also need to weigh up the cost. So if you don't really have $400,000 to $500,000 in super at this stage, then it's probably not cost effective to set up a self-managed super fund at this stage yet.
Yeah, and just on top of that, Gladys, in addition to cost effectiveness, at Hewison Private Wealth, our investment philosophy is really driven by our preference for direct investing. So what I mean by that is that if we're investing in shares, what we prefer to do is select the individual companies that we want our clients to invest in. If it's property, we've had great success with our clients investing in property syndicates. So arrangements where you can pool your funds with other investors and buy high quality property. Also fixed income type assets and international equity. So in addition to cost effectiveness, what we find is that as advisors, you probably can't diversify your superannuation assets or really take the greatest advantage of those investment opportunities until you've got that $400,000 to $500,000. And that's where there are other more cost-effective arrangements that you could look at to invest your superannuation fund. But just on that point, Tom, when we're talking about balances, if you're a couple, you can obviously consolidate your superannuation with your partner. So if you've got a couple $100,000 each, the two of you could set up one fund and therefore get that economic scale to make it cost effective.
Yep.
So look, just to sort of recap the outcome of rebalancing, Gladys, perhaps you can just go through once again the outcome of why we rebalance and the benefits of that.
Yeah, so the whole idea of having an asset allocation is so that it's there to help you achieve your goals. And as Glenn mentioned, when the market moves, it changes the risk in your portfolio. So rebalancing your portfolio back to the desired asset allocation, we know that we are managing the risk within your portfolio. And it also really removes any emotions out from the decision-making equation. So when the market is doing well, as Glenn mentioned, like people want to hold on to shares or buy more shares. But if your asset allocation is telling you you are overweight shares, then you have to reduce your exposure to shares. So it really removes that emotions, because people do get excited, obviously, when the market's doing well. People want to get into the market, but when it's going down, as we've seen what happened, it happened in March early this year, people are afraid and people are trying to exit the market because they don't know what's going to happen. So at that time, it is counterintuitive to buy more shares. But if your asset allocation is telling you you are underweight shares, then you should be buying more shares. And that really explains the whole concept of selling high and buying low.
Yeah, and it's really, I mean, we obviously have followed Warren Buffett very closely, and I think the rebalancing, as you were saying, the contrarian approach, doing the opposite of what your mind's saying. It's that old quote from Warren Buffett is to be greedy when others be fearful when others are greedy, and greedy when others are fearful. So what that basically means is that when your mind's, or when everyone else is saying, oh, the share market's bad, there's a lot of risk, there's a lot of fear, that may be the best time to take a step back, take a deep breath and say, well, look, there might be some opportunities here. Mm-hmm. And that's the same with every asset class, whether it's shares or property. It's all about taking the long-term view. And that's why we've really spent a lot of time trying to really press home the fact that you need to align your strategy with your objectives, because if you've got a long-term strategy and you can identify good long-term assets, then really you don't have to worry what the market's doing in the short term, because if you're not forced to sell, then you're not crystallizing those losses. And I suppose the bottom line is that whether it's shares or property, if you can't tolerate an asset that can fall by 30, 40% within a short period of time, then you probably shouldn't be investing in that asset class to begin with. But that's where that asset allocation becomes really important, because as we've spoken about, diversifying across different types of assets reduces the reliance of your portfolio on one particular asset class. So you don't have to worry, oh no, shares aren't doing well, because you've got these other asset classes that are cushioning the downturn. You might have your property assets that are doing well. So quite often in investing, what we try and do is to have assets that are what's called negatively correlated. So you might have a situation that if shares are falling, perhaps there's some other assets that are going up. So you've got a return somewhere in the middle. But really, to reiterate the importance of having a strategy, having an asset allocation, sticking to that asset allocation unless your strategy, unless your objectives are changing, but then actively rebalancing. And in our view, that's the most successful way to manage risk, maximize returns, and really do what investing is all about, which is sell high, buy low. Unfortunately, by following that herd mentality, by listening to the noise, a lot of people sell low and buy high. And that's just because they don't have a strategy, they don't stick to it, and they're really letting the external noise impact their investment decisions, as opposed to having a strategy. And as we've been talking about, the portfolio will tell you what you need to be doing. So there's no need to try and time the market. If you've got a strategy, you review it and you actively rebalance at the right times, that can really set you up for the future. So I think, Gladys, we've got one more question. Actually, there's a couple of questions here.
Yeah.
Did you want to just read out the first one, Gladys, and give that a go?
Yeah, we've got a question from Nick. So the question is, do you consider in this scenario a minimum holding period due to tax implications, i.e. capital gains tax, so you won't sell in 1 year, understanding that you're not trying to time the market?
Yeah.
Yeah, so great question. Well, when we rebalance portfolio, yes, tax do play, I guess, it is a consideration, but it is not something that we really focus on when we rebalance portfolios. So let's just use car sales as an example again. Our client has held the share for less than 12 months. And the question is, should we be taking profits because it has gone up by 40%? And yes, you're not going to get the 50% capital gains tax discount, but then you can hold on to the share, but then there's also a possibility that the share might fall tomorrow and you might lose all your gains. So from our point of view, yes, we consider tax, but then in this case, we will still be recommending the client take profits, even if they're not getting that discount.
That's why, I mean, we work very closely with our clients' other professional advisors, so accountants, solicitors, and so forth. But I sort of tongue-in-cheek say it, but I have said to clients before that my job is to give you the biggest tax problem of all time, because if I'm doing that, then you're making great investment returns. So as you said, Gladys, tax is a consideration, but we don't want that to dictate our decisions, because you might try and hold on to a share for another 3 months to get that 50% discount. But at the end of the day, the share price may fall, which could completely offset that. The next question is, with the case study, if the couple had a mortgage, would you recommend using all or part of the inheritance to pay off the mortgage, or invest the inheritance in a portfolio? I was going to say this at the end, but obviously what we're talking about here is very, very just general in nature. We're just using hypothetical examples. You really need to speak to your advisor. But generally, as advisors, what we're looking at, if we're comparing or looking at a comparison of investing or paying a mortgage, is what return is required from an investment to beat paying off your mortgage. So for example, if you think about a fixed income type investment, and let's just say it's generating a 7% income return, which in this environment is pretty good, what you need to take into account is the tax implications of that. So for example, if you're on the top rate of tax, almost half of that return is being eroded by tax. So that 7% return can turn into a 3% net return. So when you're looking at, should I repay my mortgage or invest, you need to look at what's the net investment return that I need to get to beat paying the mortgage. So let's just assume mortgage rates of 3%. I use that hypothetical mortgage investment return of say 7%, you can see that you almost need an investment return of beyond 6-7% in the current interest rate environment to beat paying off your mortgage. So generally as advisors, although that return is achievable, because it's not guaranteed, we'd probably say, look, you're probably better off paying off your mortgage because it's giving you a guaranteed rate of return. You're saving interest, which isn't taxed, and you're not exposing yourself to any investment risk whatsoever. So that's generally what we would be saying in that regard. But once again, important to seek advice from your advisor in that regard.
So we've got a question from Anthony. How does asset class percentage allocation change as one approaches retirement? So great question. So as you approach retirement, the need for you to rely on the income from your portfolio increases. So the whole idea of saving enough for retirement is so that your nest egg can produce sufficient income for you to draw upon during your retirement. And that's something that we really focus on heavily at Hewison Private Wealth. So as you approach retirement, then your ability to take more risk reduce. So your exposure naturally to growth assets like shares and property wouldn't be that high. It's very hard to give specifics as to what percentage to which asset class, but in general terms, your allocation to growth assets will be lower and your allocation to defensive style assets like cash and fixed income will be higher. Because at the end of the day, we know that we want to protect capital and we know that we want the portfolio to generate a higher level of income so that you can rely on that income to fund your retirement needs.
And that's where it might be a progressive thing. Is that right, Gladys? So, we're not saying that, because sometimes you may not change your asset allocation at all. It depends on how much you've got in superannuation, what your income need is. But what we generally find is that alteration in your target asset allocation is a progressive thing. So you're not going to, retire at age 65 and then just change your asset allocation like that. It may be a progressive thing that you alter as your objectives change. But as I said, we've had many situations where a client's asset allocation may be the same from, the accumulation phase and through retirement. It just really depends on your underlying situation. But as Gladys was saying, it's normally perhaps a heavier weighting to those income producing assets, because the way that we try to structure portfolios is that they're generating the cash flow for you to live on in retirement, so that you don't have to worry about ever having to sell capital in a time like this where capital values might be depressed and you don't necessarily want to be selling them. So if you've got that income generation, it just enables you to sort of sail through these difficult times. Just another question here. With COVID-19, for someone looking to start investing, isn't there quite a bit tough times ahead? Would you hold for a short period before entering the market? Look, the danger there, as we've been talking about, is if you want to sit on the sidelines, the question is for how long? And you could be sitting on the sidelines for weeks, months, and years. I mean, we've got clients that are seeing us now that have been sitting on cash since the global financial crisis, because at that particular time there was a lot of fear, a lot of anxiety. Markets had fallen. They were so anxious and fearful about investing in the market because they thought it would fall further, that they've sat on cash forever. And then markets rise and you think, well, maybe I'll just wait for it to come off again. And really the danger in trying to time the market is you can sit in cash forever. And as we're seeing now, cash rates are so low that you're just not getting that reward for no risk. So our view, as we've been talking about, is to, if we're thinking about investing, understand your objectives. If you've got short-term objectives, then no, you shouldn't be investing in shares or property regardless of what the climate is. But if you've got a long-term objective, then our belief would be have a strategy, invest now. And yes, the market may fall, but that's where the diversification of your portfolio is really important, because if you were to have a portfolio diversified across different asset classes, which included some shares, then you're right. Yes, if there's a third wave in Victoria, if the impacts of COVID-19 get worse, then the share market may fall. But that's once again where the benefits of having that diversified portfolio come into play, because we can draw on our fixed interest and top up shares. And I think that just the last 6 months is a perfect example of that, because when March, it was really the very early onset of COVID-19. No one knew what was happening. There was a lot of fear. The market fell 40%. I would be saying that a lot of people were saying, well, it's just going to get worse. Let's just sit on cash. And if they've been sitting on cash, they've missed out on a 20% recovery. And that's always the danger. History shows us, and a lot of analysis and research shows that it's really time in the market that far outweighs trying to pick the best time. And if you just miss the best few days of a market over a year, you can substantially cut your return. So we would say, align your strategy with your objectives. Anything to add to that, Gladys?
No, we've covered all. Do we have any more questions?
I think that's all the questions we've got, Gladys. From what I can see, it's probably dead on time, to be honest.
Okay, so we've come to the end of today's seminar. So thank you so much all for your time today. So next week, we've got Andrew Hewison, our Managing Director. He will be having a conversation with the Managing Director of Newmark Capital, Chris Langford, next Wednesday, same time at 12 o'clock. So you'll be sent a follow-up email after today's session with your chance to register for that session next week as well. So Hewison Private Wealth, we're always creating new and relevant content. So just please feel free to follow us on all our social media channels. We're on LinkedIn, Facebook, Instagram. And as Glenn mentioned, we also have a podcast which he and Nathan and Leah co-host together. It's called the Money Mentors Podcast, which I believe you can find on Apple.
iTunes, all the best apps. It's right up there at the top.
Yeah, so please feel free to give all our social channels a follow and like all our posts. That would be really great. So yeah, it's been great sharing all of you with the information today on the importance of asset allocation and rebalancing. Thanks for your time and have a great afternoon.
Thanks, everyone. Thanks again. Bye.